Hello traders, this is Chris Buss with Traders Profit Compass. I've had a few requests to go over bracket trades, so I thought I'd put together a little video to explain some of the details about it and hopefully crystallize it for you. So let's get into it. A bracket trade is essentially when you alarm both the high side and the low side of a trading range and then sit patiently by and wait for price to trigger that alarm as it moves outside the range. And there's really two situations where this sets up really well. One is when you get a price gap due to some news or earnings, and then the other situation is when you've got price in a well-defined trading range where you can identify support and resistance very well. Then you can alarm those levels and wait for price to make a move. So let's look at a few examples. Here we've got a chart on a line, and I wanted to show you this one because it actually has both setups for you to take a look at. Price had gapped down, and you know, the thing of it is you're going to pick up a chart at any point in time. So let's say you picked it up and it was down here at the bottom, and you could see that support was being established, and on the high side there was definitely a resistance level there at 190. So what you could have done is box that area in and just wait patiently by until price made a move to the top side, breaking out of that range where it would trigger a long. So you would have gotten long here on a top side breakout of that trading range, and then most likely held it until here. Now, I don't personally hold stocks through earnings, so if I were in this trade, I would have exited here because this gap was due to earnings. So I would have been out. The stock had earnings, then it gapped up again. And you can see what's really neat about this setup is it gapped up right into the middle of the range of this open gap over here. So what you do is once the day trading range has been established, so it gaps up. The high of the day was 250. The low of the day was 235. You set alarms in your system at both levels for a break above 250 or a break below 235. And so you can see the next day was a narrow range day. Inside of the range, there's no trade. The next day, it went up to 250 where it was stopped. Again, no trade. And then the next day, your high side alarm would have been triggered where you would have gotten long just above 250. Now, the next 2 days after that, you can see that price probed back into the trading range, but it never closed there. So you wouldn't have been stopped out. And then price has moved up gradually since then. One thing to point out when you've got these gaps is that if price gaps up, then a move to the top side breakout is favored. If it's a gap down, then a price move below the range is favored. So in this case, it did break out above. I expect this will go up and tag 270 where there's resistance, and then you have to decide how you want to manage your trade from that point going forward. The purpose of the bracket trade is to simply alarm levels where you can go with price out of a well-defined trading range. So in both these instances, it did that. Here, it let you know when price was moving out of the base, and here it let you know when price was moving above the trading range established on that gap up day. Here's a example of a gap down on band. It just happened yesterday. You can see here that price was up here at 55. They reported earnings. It gapped down, went all the way down to 42.5, and then rebounded back up to 47.5. Today you can see that it's up a little bit. But what you want to do, and I found this is important, is to alarm the entire range of trading on the gap day. So for instance, here you can see the wicks went all the way down to 42.5. I would mark that as the low end of the range. And then on the high side, you've got the wicks that go up to 50. I would mark that as the high side of the range. Now, from here on, you can decide how you want to manage the trade. So in this particular situation, the low side is 42.5 and the high side is 50. That's, a $7.50 range from high to low. You might be a person that says, you know what, this is going lower. I'm going to short against 50, and I'm going to play for a trade down to the bottom side of the trading range down at 42.5. That's totally fine. It's an objective place to short at overhead resistance. You may be a person that says, hey, I'm going to wait until I get a price move above or below the range before I take a trade. That's a totally personal decision based on your experience, your trading style, and how wide is the range. If this was only $1 or $2, it wouldn't be worth it. But at $7.50, that could be a real profitable trade if it goes back down to 42.5. So the alarms at least give you a level to watch and trigger, so you won't forget about having that opportunity out there. This is Baxter. It had a breakdown a couple weeks ago. You can see here that it had a range from all the way from 82.5 down here to 77. And it's been consolidating at the low side of the range. I have 77 marked and alarmed in my system for a breakdown. I'm not personally interested in playing it to the high side, but normally I'd alarm both the top and bottom side of the range. One thing to note, and I don't know if I said it already, but when you have a gap down, a price break below is favored versus coming back up and breaking out of the top side. So, but it's just favored. It's not an absolute rule, because you will see gap downs recover and go back up. So anyhow, that's just a tendency to price to follow the direction of the gap. Here's one on DXCM, which is really interesting. It gapped up $30 yesterday on earnings, went up to 200, had a low side of 183 or so. And then you can see today it went up and tagged that 200 again. That really tells you that's a real level there. And above 200 you got blue sky, and below 183 you've got a $30 gap below. So this is really like kind of a dream scenario, that if you get a move to the top side, there's really no overhead resistance, and if you get a move down through the bottom side, you've got a $30 gap to fill. So in either case, either a break above or a break below, there's a good opportunity there. So those would be locations to alarm in your system. Here's an interesting one on Expedia. I'm sure you're all aware of it. It had a gap down yesterday of $20, and then it went ahead and lost another $18 intraday, and now today there's a little bounce. So there's a lot of ways to play this. You can play for a bounce. I dropped in the Fibonacci numbers here just to see where a bounce might take it. Here at the 38% level, you got would be at 112, 50% around 116, and then 16.18 up here at 122. Again, this is where your trading style will come into play. What are the chances it's going to go even lower after dropping $38? You've probably got more opportunity playing for a bounce short term than waiting for a breakdown. So at least from this point, you can decide how you want to play it, whether inside of this huge range, against 98, which was the bottom of the range. So you got $2 a downside and $36 of potential upside if the stock recovers. So in this particular situation, I'd be more motivated to look for recovery with a tight stop down at 98. This is an example of BIG, the retailer, discount retailer. Here, you can see price was in a very narrow consolidation range for over 2 months, right here at gap resistance. So at the time, I had this area boxed in and alarmed both on the top side against the gap, and then on the bottom side, I exited, or I wasn't even in the position. Then on earnings, it gapped up, and again, it gapped up into the middle of a prior gap. So again, boxing in the range on a breakout, you could play for that gap fill, and then again, it consolidated in a narrow range and broke to the downside. And if you had that alarmed, you would have had a good heads up to get short, which would have been a great trade. Now lately, it's been consolidating in a much wider range from 20 to 24.5. So depending on what you wanted to do, I would alarm 20 and I would alarm 24.5 and wait till it resolves, because it's going to go one way or the other. I personally believe this is going to break down, but that's besides the point. You'll have the alarm set, and if it does or if it doesn't, it really doesn't matter. It'll give you a heads up if there's a breakdown, and if it holds, you could play for the top side of the box. So again, that's personal trading style. Just to show you some of the head fakes and pitfalls that can happen with these trading ranges. This is Burlington Coat Factory. And I don't know if you can see it here, but there's price gapped up right here on earnings from 93 to 206. And you can see the following day you had a head fake. It broke above and then closed below. So if you were an intraday trader or sitting there watching it all day long and that alarm went off, you would probably been inclined to take that trade long, and then it would have been a head fake. You would have been stopped out when it fell back into the range. So what you do in that case is you've got to expand your box and reset your alarms. So in this particular situation, I came in and I picked up this this downside price activity from this would have been a head fake also, along with these. So I expanded the range, and now I've captured that entire trading range with my box, and I have an alarm on the top and an alarm on the bottom. And you can see here as price comes up to the top of the box, it's an objective short right here because this is resistance. So you can play for a move back down to the bottom of the box, which is over $10, which would be a nice trade, and you'd set your stop just above the top of the range here, just above overhead resistance. And if you get stopped out, you get stopped out. And then if it breaks out, you can take it long. So having these ranges alarmed will give you a heads up when price is at an objective location, because you're not going to remember to look at them every day. So having those alarms will be key to bring that stock back into focus for you, after, weeks and weeks of chopping around. When that alarm goes off, you can make a decision. In this particular instance, am I going to try a short, or am I going to wait for it to break out and go long? So there are head fakes. All you can do is, honor your stop, reset your alarms, and then wait for another trigger to hit. Oops. I'm going to go back and do that. Sorry about that. So just as a recap, after you've got a gap move, a gap higher favors breakouts and a gap lower favors breakdowns. And that's especially true if the gap is in a direction of the prevailing trend. So if you got a stock in an uptrend and then it gaps higher on earnings, there's a high probability that move will continue higher. Same thing on a gap down. If you've got a stock already in a downtrend and it gaps lower on earnings, there's a very high probability that it's going to continue to the downside. And I think it's important when you start doing these to establish some rules that fit in well with your own trading style. I'm of the opinion it's best to wait for end-of-day closes on these breakouts and breakdowns. You'll see a lot of intraday probing by price, breaking above a range but then closing below. Or on the downside, probes below the range and then closing back in the range. And that can be really frustrating if you're sitting there during the day getting these alarms and then taking them and then, getting stopped out 2 hours later. What I like to do is just, wait for the day to close. Wait for a confirming candle, either above or below the range. And then, take the trade. And if you want to do that, 15 minutes before the close, that's fine. If you're at your desk and actively trading, you can do that. If you're a busy professional that is working at your career, you can come home, see what alarms have triggered, see where the end of day closes are, and then decide if you want to put on the trade the next day. And like I said before, if the trading range is wide enough, don't discount the possibility of doing something within the range, especially if you've got a wide trading range and there's some good opportunity to play with inside the box. That's what I'm trying to say. How do I find the gaps? Well, if you're in stock charts, if you go to the member tools section, they have some predefined scans where you can, if you hit that tab, you'll get a whole array of all the predefined scans that they have for people, and they have several for bullish gaps, and then they have a section for bearish gaps. You can go in and click each one of these. They have some columns where you can sort those results, in different price levels. You can actually even go in, if you're a member, and craft your own predefined scan criteria. If you want only stocks over $10 or whatever your criteria may be, you can write a custom scan for that. But if you just want to look at their predefined ones, you can go in there, sort the columns, and then pick out ones that you want to investigate further. If you're using Thinkorswim, you can go to the scan tab. You can load, they have a public scan where you can load for a gap up or a gap down. You can put in whatever sort criteria you want, and then put in any kind of volume criteria you want, hit scan, and then you can sort your results by percent change. Now what I want to do is I'm going to exit out of the PowerPoint program and show you a live example of doing a sort on Thinkorswim. So here we go. Let's give it a try. So here's my matrix on Thinkorswim. So I'm going to go up here to the scan tab. I'm going to go over and load public scan for a gap down. I'm going to hit that. I'm going to go here, and let's say I only want to look at stocks over $10, so I'll put that in, and I want to look for stocks that have at least 500,000 shares traded. I can go here and hit scan. It gives me all the stocks that fit that criteria. I can go here and sort by percent change. And these are all the gap downs with the percent changes shown. And you can go down the sides and look at the tickers for ones that you may be familiar with. You can save these to a chart list. You can save them to a watch list. You can just write down the ones that you're interested in investigating further, and then go back into the system and set your alarms. You can also go here, and I think I showed you where you can load gap up, do the same thing. And if you want, you can save these as your own personal scans. So here's all the gap ups for the day. You can sort them by percent change. You can see the ones that jumped up today on earnings. So let me go back to the presentation and wrap it up for you. Pulling it all together, I hope this was beneficial for you. The bracket trades offer you very objective trade locations to either go long or short, and that's really the most important element of it. If price is moving outside a well-defined range, then you have a level to shoot against, either on the long side or the short side. You can set these brackets up on gaps or on well-established trading ranges. And if the range is wide enough, you can trade within that range and get some real good productive trades out of it. As we talked about, the directional moves out of the gaps favor the direction of the gap. So gaps higher, favor moves higher. Gaps lower, favor moves lower. But as a rule, I always alarm both sides, even though one direction may be favored over another. And like all setups, they're not 100% foolproof. You are going to get head fakes. You are going to get stopped out. But I think it gives you a real good baseline setup to have objective trading locations where you can locate your stops very close by. If you do get a head fake, you're only going to lose a very small percentage. And if they work, they can be really, really profitable, especially when you get, gap backfills where price can move really fast. I've had some fantastic trades on, breakouts where they backfill the gap or even go higher. So they can be really, really good trades, and I've found it's worth the headache of getting stopped out occasionally for the opportunity to have some real nice winners. Okay, I hope that sheds some light on bracket trades for you. If you haven't done so already, I'd really appreciate it if you went and visited the website, tradersprofitcompass.com. It's free. You'll get actionable content that I send out at least 6 times a week, and often many, many more times, during the day and on weekends. Anything I'm seeing in the market. If you've got a question, feel free to reach out to me. This is my email address. I'd be happy to answer any questions you might have, or do my best to help you if you're stuck on something. Be happy to try and help you work through that. So again, this has been Chris Buss with Traders Profit Compass. Have a good trading week. Good night.